Validation Bill Number 2, third reading.
Call on Government Order of the Day Number 3.
Taxation, Annual Rates, Employee Allowances and Remedial Matters Bill, first reading.
Speaker.
Honourable Chris Tremaine.
Mr Speaker, I move that the Taxation, Annual Rates, Employee Allowances and Remedial Matters Bill be now read a first time. I nominate the Finance and Expenditure Committee to consider the bill. Mr Speaker, I move the Taxation, Annual Rates, Employee Allowances and Remedial Matters Bill is a bill which sets out to bring greater clarity to the tax rules and make them easier for businesses and other taxpayers to understand and comply with. The bill proposes clarifications to the tax treatment of employer-provided accommodation allowances and other payments provided by employers to employees to reimburse them for expenditure incurred. Mr Speaker, where a person receives remuneration as part of their employment to cover expenses such as accommodation, meals and clothing, it seems only fair that these items should be treated as income of the employee because the employee benefits from them. However, situations arise where the private benefit is minimal or hard to measure, and the benefit is clearly not a substitute for salary or wages. The proposals in this bill therefore aim to provide practical rules to help determine where to draw the line between what is taxable and what is not. The main areas of concern addressed in the bill are employer-provided accommodation, allowances and payments, particularly when they are linked to business travel, secondments and projects. There are a range of proposals dealing with accommodation and accommodation payments, but in particular, the bill proposes that accommodation and accommodation payments provided to employees who are required to work away from their normal workplace on secondment or capital projects will be exempt from income tax under defined circumstances, including an exemption for up to 5 years for people working on Canterbury earthquake recovery projects, which is a very good initiative. In a similar vein, an exemption is proposed for payments for meals on work-related travel for up to a 3-month period. A specific exemption is proposed for distinctive work clothing to match the outcome when clothing is provided directly by the employer. Associated with this, an exemption is proposed for plain clothes allowances when a person has been provided with a uniform as part of their employment, but because of the nature of their current duties is required to wear plain clothes instead. The proposal simply confirms current practice, and the government is keen to bring clarity to this issue. Turning to another matter, Mr Speaker, the government wants to ensure that innovation remains strong amongst New Zealand businesses. An obstacle to innovation is the business expenditure of a capital nature that is not immediately deductible for tax purposes and does not give rise to a depreciable asset, so cannot be deducted as tax depreciation over time. Such expenditure is commonly referred to as black hole expenditure. Members might remember that this was first announced as part of the Budget 2013 and contributes to the government's aim of building a more productive and competitive economy that supports innovative businesses, investment, jobs and, of course, growth, which I know David across the House is always interested in discussing in detail. The two broad areas of the black hole expenditure are focused on certain company running costs and, secondly, the costs of applying for patents, resource consents and plant variety rights. Mr Speaker, this bill also proposes changes to maintain the integrity of the tax system and to ensure that everyone pays their fair share of tax. To that end, amendments are proposed targeting taxpayers who have a disproportionately high level of debt funding in relation to their worldwide interest expenditure and taxpayers who can control the relative levels of their debt funding and equity funding. These proposed amendments relate to the issue of base erosion and profit shifting by large multinationals and is a priority matter. Different aspects of the rules relate to situations in which New Zealand residents have investments in non-resident entities, called the outbound rules, and situations in which non-residents have investments in New Zealand residents, namely the inbound rules. The rules also require taxpayers to determine which related entities are in their New Zealand group and in their worldwide group for the purpose of calculations. Changes are also proposed to the rules about New Zealand groups and worldwide groups, following from the introduction of the concept of non-resident controlling groups. Also in the international tax area, members may be aware of the United States legislation, the Foreign Account Tax Compliance Act. This Act is due to take effect on the 1st of July 2014 and requires financial institutions in countries outside the US to report on certain US account holders directly to the US's Internal Revenue Service or face a 30% penalty tax on US-sourced income. The New Zealand Government is happy to contribute to the global effort to eradicate tax avoidance and evasion, but is also aware of the compliance costs of this requirement for New Zealand financial institutions. Negotiations are therefore underway to enter into an intergovernmental agreement with the United States, which would significantly reduce these costs. The provisions in this bill will provide the necessary laws allowing financial institutions to comply with FATCA and thereby avoid the 30% withholding tax on US-sourced payments. Well, you can discuss that in your speech. The bill also addresses the tax treatment of agreements for the sale and purchase of property or services denominated in foreign currency. The foreign currency agreements, in order to reduce complexity, minimise volatility and reflect economic reality. Amendments are therefore proposed which will require taxpayers using international financial reporting standards to follow their accounting treatment for foreign currency arrangements. This means the value of the property and the services and any interest included in foreign currency arrangements will follow the accounting treatment. Similar rules will apply to taxpayers not currently using these standards. Mr. Speaker, another matter of significance in this bill concerns tax law relating to leases and licences of land. It is necessary to ensure a consistent and coherent tax treatment of land-related lease payments and remove distortions, thereby improving business efficiency and fairness. This is a comprehensive bill, there's no doubt. The main amendments include tax lease transfer payments that are substitutable for taxable lease surrender payments and lease premiums. This bill also includes proposed amendments which will help clarify the law so that charities which are removed from the register of charitable entities have a greater level of certainty about the tax consequences of deregistration, an important factor. The tax obligations for some of these entities has not always been so clear. It must be pointed out that the tax rules relating to deregistration have in the past been exploited by some in order to gain a tax advantage. The bill includes proposals to deal with this appropriately. One of the proposed amendments is intended to ensure that assets and income accumulated by charitable entities which are later deregistered are distributed to charitable purposes. The bill proposes rules to confer tax-exempt status on a small subset of community housing entities that provide housing assistance to low-income households. The amendments would promote home ownership for New Zealanders who would not otherwise be able to afford to buy a home. The new rules also set out that gifts of $5 or more which are made to one of these entities will qualify for donations tax relief. Clarifications are also proposed to the GST rules, including the definitions of dwelling and commercial dwelling in the Goods and Services Tax Act of 1985, an amendment to the apportionment rules so that non-profit bodies can claim all of their GST input deductions other than on inputs that relate to the making of exempt supplies. Also, a proposed amendment which clarifies the policy related to subsequent supplies of land or dwellings when input tax has been claimed, requiring a wash-up calculation on the disposal. An amendment to clarify the tax treatment of directors' fees, the zero rating of land, and the proposed amendments relating to residents and non-residents to the meaning of outside New Zealand to clarify that for a natural person, a minor presence in New Zealand that is not directly connected with the supply does not invalidate the rule. As I said, Mr. Speaker, this is a comprehensive bill. It is proposed to give Every Home Global Concern Incorporated and the Namibian Charitable Trust donee status in Schedule 32 of the Income Tax Act 2007. Monetary gifts to them may qualify for tax benefits. The remaining proposals in the bill set the annual rates for income tax for the 2014-15 tax year and make minor changes to the child support and working for families rules to ensure they work as intended. Minister Macleay has no doubt been doing outstanding work with this bill and has pulled this comprehensive bill together to ensure that our laws are routinely maintained in response to changing circumstances or good advice from the business sector, and efforts are taken to ensure that taxpayers understand exactly what their obligations are. This bill brings further clarity and certainty to our tax system, and I am therefore pleased on behalf of Minister Macleay to commend the Taxation, Annual Rates, Employee Allowances and Remedial Matters Bill to the House. Thank you, Mr Speaker.
The question is that the motion be agreed to. Dr.